We got Ian Drewe with me here today. You can learn what his team is up to by going to avocaproperty.com. I'm going to have that as a clickable link in the show notes.
Thanks, Jack. Well, it's a pleasure to be here. Thank you so much for having me. Looking forward to unpacking it, as you said.
Well, let's start things off. It's always good to hear a brief origination story. It's almost sounds like a superhero movie, but how did you find your way into real estate investing?
Goodness. So, as you can probably tell from my accent, I'm not born and raised in the US. I'm an Australian who married a New Yorker. We were both bankers. We just had a child and we moved here in 2008. And I had all these ridiculous notions of not having ever worked in Wall Street before, having worked outside of the US quite deliberately. I had notions of wandering down to Wall Street and saying, "Hi, everyone. Who wants me?" We arrived 2 days after Lehman's collapsed, and it was very apparent that that was not going to happen. In fact, as you, I'm sure, are aware, it was an incredible time. I met some extraordinary people who were quite literally wandering up and down the streets, and so I was able to form my own financial advisory firm. But at the time, we definitely needed a plan B and D because things were looking pretty shaky. And so I did a ton of research and eventually settled on multifamily property as kind of the asset class that I wanted to explore and to develop. So I took a path that was kind of odd, and you'll see that this is a theme throughout the course of my multifamily journey. I thought, you know what, I'm going to buy a property off my own balance sheet, and it's going to be my learning property. So I came up with the idea, which I thought was a smart one at the time, that I'm going to buy a property in a city that I thought would recover the best. But the property itself, I wanted to be in the worst location so that I would have everything that would happen to that property known to mankind, would experience it, would learn from it. And I got exactly what I wished for. I won't elongate the experience that I had. Suffice to say that the property that I chose, unbeknownst to me at the time, was in the worst part of Austin. It was the back garden of this property was the hub of all forms of organized and disorganized crime. And it ended up with, I was in Hong Kong at the time. So for the majority of ownership of this property, which I ended up owning for about 10 years, the city of Austin tracked me down and look, we are trying to enforce some codes. Your current property manager is chasing our people away with a gun. And if you don't essentially rectify the issues, we're going to raise the property to the ground. We saved the property. We ended up selling it, but it was an experience from which I learned a lot. And bizarrely, I chose to do that as my full-time profession, forming a vacant property in 2022.
It sounds like you're primarily focused on multifamily investing now.
Yes, my background is a commercial lawyer and a banker. I was fortunate enough to work in capital markets and real estate infrastructure transactions for 25 plus years, lastly in Wall Street. And then in 2022, I retired from Wall Street, formed a Voca Property, and we now focus exclusively on multifamily property. We acquire A, B, and C class properties in Texas, Florida, Oklahoma, and South Carolina. We have a wonderful investment team with whom we work to do that.
On your website, you talk about when you acquire, you're also renovating, stabilizing the multifamily properties. Can you talk about that typical process and identifying and executing on these deals?
Yeah, so we are reasonably open and agnostic in terms of the asset class that we will look at. So we will look at transactions where essentially the value add is operational, and we closed on a terrific 288 unit property down in a place called Bar, which is next to McAllen in the south of Texas, where that really was the play. There was very little to do in terms of CapEx for that property. It was totally operational. On the other hand, we have looked at and acquired, and we love high touch properties where there is a bunch of work to be done. It could be across the board in terms of CapEx requirements. As far as we have partnerships with developers and we're able to acquire land in addition to the existing multifamily buildings and build upon that, we worked with, and it's all about partnerships. And we're very lucky to have formed some partnerships with wonderful people who are either local to the area in which we're purchasing or not necessarily local, but still have sufficient expertise and experience to get the job down there. We will look at and execute on all of those particular plays.
So, based on your experience, and you're from Australia, you have this legal background and a few other things. Are you seeing any trends that you've identified over the past few years, as now that you're in the thick of it?
Goodness, that's a wonderful question. Look, I think in terms of trends, I think, and this doesn't necessarily pertain to being a legal or banking question, but just I'm seeing the same as everyone else. And that is that we are coming across portfolios and single properties that are being sold for essentially the same reason, which is that the prior owner, when interest and when funds was extremely cheap, were simply buying these assets and hoping to ride the wave and not really underwriting according to the fundamentals. And I think that we, as everyone else, are seeing that that obviously didn't work when the terms of the loan under which the property was acquired changed. The firms were looking to enter refinance at higher interest rates. They weren't able to, because the solid fundamentals weren't there. And so we're kind of telling our investors, we're telling everyone that will listen, regardless of the state of the economy, regardless of the state of the world, you need to continue to underwrite according to basic fundamentals. There's no running away from that. I think the topic of the day is tariffs and what effect that will have on the industry. I was fortunate enough to have participated in a fabulous conversation with the lead economist of Moody's and various other industry heads. And I think the message was that the biggest effect of tariffs is the uncertainty that is kind of pervasive throughout the investor community. As a multifamily operator, there's not a lot that I can do about that. Suffice to say that the fundamentals underpinning the beauty of investing in multifamily is that people need homes, people need to live. And again, regardless of what is going on in the world, you can underwrite according to the fundamentals. If you can approach a transaction and make sure that you take care of all of the kind of business objectives, because of course, every acquisition, as I say to people, is really the acquisition of a business. And so you are looking at every property as a separate business. And as long as you stick to the fundamentals, the demand for multifamily property, for better or worse, is there because there is a chronic housing shortage. So how does that relate to tariffs? Well, tariffs essentially, really the key impact for us as an industry is the effect that it's having on investors. If you can maintain the message to investors that, look, the fundamentals underpinning multifamily property have not changed, they will not change in the foreseeable future, again, for better or worse, and it's a whole other political discussion. I think that the opportunities are still remarkable in our industry.
Hmm. I would be curious, based on how you handle things now, how does data and technology incorporated in how you underwrite deals and how you're finding the next one?
I mean, a wonderful question. I've got two sons. Laugh at the fact that when I started working, there was a period where we didn't have computers. We actually wrote down, physically and wrote stuff in files when I first started working at a law firm, which is a complete anathema to them. And so I was really spoiled throughout the course of my career. I had IT teams. I could barely turn on a computer. I really didn't embrace technology to the extent that it was provided to me. And if I had issues with it, there were teams that would fix it. To that extent, I really didn't, as far as I was aware, need to embrace it. Now that I have my own firm, I've gone the other way. With the advent of AI, you have to embrace AI. It's an incredible time for everyone, not just the multifamily, but every industry, particularly if you are a reasonably small firm. The opportunities that are there that are being driven by AI, really, again, I'll bring it back to multifamily. Across the board is quite extraordinary. I'm fortunate enough to be a member of several groups that specialize in AI, and it's wonderful for me because, as I said, I am not challenged. I need to be made aware of how all this is, the opportunities that this presents. I think from a deal sourcing and underwriting perspective, there are systems out there which aren't cheap, but they have completely changed the way that we approach our ability to source deals, you underwrite deals. The manner and the speed at which we are able to do that has completely changed. There are now systems out there that allow you to really look at, analyze, and underwrite deals in a matter of minutes. And we are talking hundreds and hundreds, if not thousands of deals that previously would have taken my team a considerable period of time to do. We now have results for these kind of things remarkably quickly. That's on the underwriting and acquisition side. The tool now in terms that allow us to communicate with investors on the investor side, which is really my focus, again, is simply remarkable. And so I was very old school when I first came into the industry. You know, I would actually call people. I still do that. It's still an absolute key part of it. But in terms of being kind of top of the list, in terms of being present in investors' conscious, we now have remarkable tools that allow us to kind of automate and have a bit of control of the process than what we did before. And I think that really you don't have a choice you have to embrace AI. Having said that, you have to do it in a smarter way than I used to do it. I started out with AI a couple of years ago, and I would invest heavily in a tool only to find out 2 or 3 weeks later that it had been replaced by another tool, which was fairly bigger and better than the prior one. So that has stopped me. It's made me more cautious and more reticent when I look at this stuff. But the opportunity that these tools present is simply remarkable and will, change the way my kids say we as a species will be kind of irrelevant in X number of years. I would argue that we won't be irrelevant, but I think the nature of the way that we do things obviously changing. Many functions that are now done by humans won't be. And again, it's a question of that may or may not be wrong in various people's eyes, but you either embrace it or you fall behind.
Mm-hmm. But we're going to jump into the next part of the interview here. We're going to be talking about some specific successes. Before we do, I want to make sure everybody is directed to your website of avocaproperty.com, avocaproperty.com. I'm going to have that as a clickable link in the show notes. If you found some value in what we're talking about so far, share this with one of your investor friends. And if you're watching us on YouTube, give us a quick like and subscribe. Can you share one of the most successful real estate investments and what made it stand out?
Yeah, I can. We sincerely hope that it will be successful. We believe that it will be successful. I want to take the opportunity to run through our latest acquisition, which is a wonderful 288 unit property. Some of the lessons that we learned, my kids laughed because they said, Dad, you're a great teacher because we learn what not to do. And I thought, you know what? That's the way I'm able to hopefully help people, then so be it. We closed on this property around the 20th of December in 2024. We first looked at this property in around September of 2023. My partner on this property is a chap who is very senior in the world of multifamily in the state of Texas. I was very fortunate to be a partner with him. We were looking at another property down in McAllen when a broker approached us and said, would you guys be interested in taking a look at this particular property called Jackson Place? We said, sure. I think that began about a 9-month odyssey in terms of the initial approach through to actually signing the sale agreement. It was absolutely extraordinary. Firstly, the broker who brought it to us wasn't entirely aware of what it was that they were selling. So essentially, this is what's called an income restricted property. And essentially, in exchange for providing housing for certain income demographics, we receive a full tax rebate, which is a highly sought after form of transaction in Texas. It was initially brought to us as a 10% requirement. In other words, we had to provide housing for just 10% of our flats to income restricted tenants. And we priced it accordingly. We would then put it in, and then a month later, we'd come back and the broker would say, oh, sorry, we got that wrong. It's actually a 50%. So we go through the process. And they come back and they said, oh, we're really sorry. It's actually a 90% requirement. And so this went on and on and on. Within that space of time, we had to deal with the city. Now, the seller was a city, which presented its own unique challenges. Within the city, they had their own approval process. And within the people, you had the various older men, older women, councilmen, councilwomen, you had the men, they had their own agendas. And so every time we would essentially make a bid, we got the lawyers involved with the terms, we were dealing with the point person at the city. Eventually we'd come back 2-3 weeks later, and let's say the bid was for 100, we'd get the response, no, it's 115. And like good underwriters, we'd say, well, why is it 100? And here are the notes. And the response was, someone just decided that 115 was better. So this went on and on for about 8 months. And we knew we had a good deal. And rightly or wrongly, I was stuck with it. And eventually we got the thing signed. So we thought at the time, okay, fabulous. This is going to be an easy one to sell because we knew we were onto a good deal. And we had to pare the deal back, and we were presenting figures that were far in excess of anything that we had seen in the market. And again, we had to actually pare it back because we thought, you know what, we could offer numbers that simply sounded unbelievable. So we thought we had hit it right. There was a delta between what we had and what we'd seen in the market today. And I guess I initially approached this as I would historically as a bank, which essentially was, if you build it, they will come. If you present a transaction to market that is so good, people will flock to it. I think that essentially was the first mistake that we made, was assuming that if we just presented a deal like this to the market, that it would come without having nurtured the relationships with investors that I had, I guess, previously gotten on board years prior. And it doesn't work like that. So if you are looking to sell a transaction, if you are looking to say to people, you should invest your money with me, you have to have created a really solid relationship. And I think that's one of the first mistakes that we made. We didn't nurture the relationship. We just assumed that the deal was that good that people would come. I think the second part of the issue for us was that as between Homer and I, we had done any number of transactions together, either on our own, off our own balance sheet, in joint ventures, but we didn't have at that stage the track record, the syndication track record that people would need. And we were able to get away with that by virtue of the fact that the lender, under normal circumstances, would say, look, you guys need sponsors. The lender in this situation, because the loan was a credit loan, which was guaranteed by the city, said to us, I don't care about you guys. I don't care about the composition of your GP team and how much experience you do and don't have. I just care that the loan is guaranteed by the city. So we stormed off thinking, this is great. We've got a wonderful deal. We don't need our normal experienced partners. And boy, oh boy, we did. So that was kind of mistake number 2 that we made. I think mistake number 3 was, and I would really, I guess, warn people potentially, is kind of working with digital marketers. So we thought the first option that we should look at is kind of digital marketers. And if you sign an agreement with a firm that essentially says, we will pay you $100 and you don't need to actually deliver anything to us, then guess what? They won't. We had 2 reasonably well-known firms that promised us the world, but the contracts, they didn't actually have to deliver them. And ultimately they didn't. We walked away a lot poorer for it. So we certainly learned our lesson, but it was an expensive one. And I would hesitate people to avoid that. The next mistake was not having the right investor pool. We thought this would be a perfect transaction. The capital raise is around 6 million, but we thought it was a really nice, given the numbers that we were offering. We thought this would be a wonderful transaction for a family office or an institution just to come and swoop in. We had an investor portal. We were using an investor portal from a company that wasn't particularly well known. I was drafting the emails, sending them out, inviting people to webinars, doing all of the things that one should do, and getting absolutely zero response. We thought, what is going on here? This is a wonderful transaction. Well, it turned out that we used the investor portal as the basis for our emails. The emails never went out. So we found this out 2 months down the track. And so now we're in a situation where we got a little bit of family and friends money. We've made absolutely no connections whatsoever with our family office investors, nor our institutional investors. And we have run up a legal bill because it took us 8 months to get to signing the sale agreement. We got a legal bill of about $150,000. It was kind of binary. We either closed the transaction, in which case the legal bill would be covered, or if we didn't, then we were up for it personally. So we were feeling the pressure considerably. We also were both members of a particular mastermind, and this is a lesson number 5 or 6 that I would warn people. Choose your mastermind very carefully. This is not Josh's mastermind, by the way. I'm a massive fan of Josh, still part of his mastermind. This is how I'm going to claim it for another mastermind. And essentially, Homer went to the head of the mastermind and said, oh, would you be able to help? We're having a little bit of difficulty raising the capital for this transaction. And essentially, having paid this group over $50,000, his response was, oh, I'll take over, get rid of him. So I started to receive phone calls from these people basically saying, yeah, you should sort of disappear and we're going to take over. And I said, no. They said, all right, we'll buy you out for, I think, 3% of what the interest was worth. And I still said no. And then I thought to myself, isn't that interesting? His advice had $50,000 while let's get rid of it. So I would hazard a guess and say, again, choose your mastermind people incredibly carefully. We finally get traction with some family offices, and they come to us, and we had a couple of funds that expressed interest. And this happened to us twice, where a couple of funds essentially waited, agreed terms that we thought were acceptable, waited until just before closing, and then said, by the way, we're going to bait and switch. We're going to change the deal completely. We get everything. You guys get nothing. Take it or leave it. You guys had no choice. Thankfully, we were able to extend with the seller who was great. The city were accommodating with us. So I would just warn people now, again, the vast majority, I think, of the funds wouldn't do that, but it can happen. So, be careful. Eventually, we were able to get the transaction oversubscribed. But again, I think the lesson for us, certainly for me, is that nurturing your investor relationships prior to deals, between deals is absolutely everything. And, what I didn't do was essentially when I established those investor relationships, particularly on Wall Street, I kind of let them go and didn't nurture them as well as I should have. And then when the time came, kind of 2-3 years later, they said, oh, nice to hear from you again. It looks interesting, but I think that you need to have that solid personal relationship if you are looking for people to invest their money with you. And certainly that's something that we are absolutely focusing on going forward.
Yeah, I know this is kind of going back to more old school single family homes and maybe some of the gurus there, but you're just reminding everybody that it's not exactly true. The whole concept, find the deal and the money will follow. We get sold that every once in a while.
In my professional background, I tended to forget the fundamentals. In my professional background, essentially, you turned up, you had the moniker of the bank that you were working with behind you, and the whole idea was that you would come up with an idea, with a structure for a transaction. You would put it to a large institution. They really didn't care who Ian Drewe was. They looked at the structure that you had developed and the bank's name behind it. What bank were they dealing with? And so you were able to kind of do that. It always helped if you dealt with people in multifamily property markets. And it should matter because, as I said, you are dealing with individuals, you are dealing with family offices, and you are dealing with sometimes institutions. And they need to know and trust you. They need to have a pre-existing relationship if they are going to invest with you, particularly as there are a lot of people out there. Relationships are everything. Looking after relationships are everything. You can't run away from it. We thought we had a good enough transaction where we could, and we learned our lesson reasonably hard that you can't. Thankfully, it all worked out in the end. I was lucky that we have a wonderful set of investors, a wonderful investor community, but you can't continue preaching that lesson strongly enough. It just doesn't work unless you maintain strong relationships with your investors.
Well, I'd be curious, after all of that, Ian, like, what's your goal? Like, what's your next 5 years? What do you have planned for your company?
So we're essentially going to operate on two fronts. We are going to continue to focus on multifamily because the opportunities right now are just extraordinary. And obviously we can't tell where the industry will be in 5 years, but certainly the aim for us is to continue to focus, and we're really going to go in two directions. We are going to acquire and operate with a handful of wonderful pre-existing partners that we've identified to do the business. And then we are going to build a fund where we are going to operate a fund of funds model. And that's simply recognizing that it's quite possible, indeed probable, that there are any number of wonderful opportunities out there where we simply don't have the time and resources to go in and be an active participant. Having said that, we have a really rigorous set of criteria that needs to be harnessed prior to us even considering to invest in these properties. There are wonderful opportunities out there where we will seek to apply our fund to investors as a limited partner, assuming that all of the returns will be commensurate with the returns that we are getting for our investors as an active partner. So that's really going to be our focus. At this stage, we love Texas. We absolutely love Oklahoma. Parts of Florida, we're not truly agnostic when it comes to Florida. There are certain areas of Florida that we love, aspects to Florida which are challenging, but again, there are really good deals to be done there. And we are going to really hone in and just focus very specifically on acquiring multifamily and on those particular areas. One thing that we will look to move into is the development side on the back and strength of some wonderful, wonderful developers with whom we've got a relationship with. We love their business model and we're looking to kind of pick that up again in the areas that I just mentioned.
Well, Ian, this has been a fantastic conversation. I really appreciate the insights and giving us those lessons learned. Avocaproperty.com, avocaproperty.com. That's going to be a clickable link in the show notes. Before we dive into the rapid fire questions and close out this episode, is there anything we should have tried to hit on?
No, I don't. I would be delighted to. It's all about investing relationships. Equally, if you're an investor that wants to speak to us, please get on the phone. We're very approachable. Whilst we embrace technology, we would like to speak to people if they're interested in learning more about what it is that we do.
Well, if you're ready, we'll dive into the rapid fire questions and close out this episode. What lie do real estate investors often tell themselves?
That transactions will work without the requisite due diligence done by them on the transaction itself and the people with whom they're dealing.
If you could go back in time and give your younger self a piece of advice, what would it be?
Oh gosh, I wish I had been in the industry much earlier. So it would be do the due diligence that I did in 2008, 20 years prior.
Do you have a book recommendation?
I'm reading I think it's called the 12-week, I'm having a Sanders moment. I can't recall the name of the author. Essentially it's not the 12-week. It's all about essentially planning within 12-week cycles as opposed to annual cycles. I'm about a third of the way through it. It's a well-known book. It's really, really interesting.
What single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Oh, we're working with a tool called Archer to source and underwrite deals, and that's changed our approach and the time taking to obtain results completely. Absolute game changer.
Well, Ian, this was fantastic. I'm going to have everything as clickable links in the show notes. But again, it is avocaproperty.com, avocaproperty.com. Really appreciate your time. It's great meeting you, and I hope you'll come back again sometime.
I'd be delighted